Hello everyone, my name is Dylan Stewart. I am a senior wealth advisor on the Mainstay Capital Management team here. Not only am I a certified financial planner, but also a certified public accountant. In today's video, we're going to be covering the Michigan Retirement Income Tax Phase Out, also known as the Public Act 4 of 2023, and also known as the House Bill 4001. We're also going to cover the enhanced senior deduction and some charitable contribution deductions as part of today's conversation too. So let's jump right in on what is not applicable income sources, specifically interest income, dividend income, capital gains, W-2 and 1099 employment income, side business income, gambling income, real estate income, really anything that's kind of sweat equity or anything from typically what's called a taxable brokerage account. From there, we can consider applicable income sources, and that's essentially all retirement income. Now, there is a few nuances and some things that don't apply, but for most folks and most clients, that's going to be your IRA distributions, including any required minimum distributions, your RMDs. And that's also going to include inherited IRA distributions, or what's called required minimum beneficiary distributions for those pulling money and mandated federally from any inherited IRA. Also, Roth conversions, annuity income, pension income, all stuff that is also qualifying as retirement income. And then from there, Social Security income in the state of Michigan, though it is a little bit different from state to state. But in the state of Michigan, and quite frankly most other states, it's already excluded from Michigan taxable income, any of your Social Security income. So when it comes to this program, it was something that was implemented back in 2023. Now that we're in 2026, it's been fully phased in. Every single year, it was being phased in a quarter at a time. And now anybody taking, again, any retirement income, this is applicable to. But there are thresholds at which this no longer applies. So for 2026, for a single filer, any retirement income above $67,610, or for joint married filers, $135,220, retirement income amounts above those do not get this phase out, do not avoid any of the Michigan state taxes. From there, we see that there is an annual adjustment, inflation adjustment applied each year. And if you're filing joint, it is based on the birth year of the oldest person in your marriage. From there, let's cover the One Big Beautiful Bill Act and the enhanced senior deduction. So, with the current administration, last July 4th, 7/4/2025, they passed this One Big Beautiful Bill Act. It essentially removes taxes on Social Security income through the end of Trump's second term, which is through 2028. And Social Security does not need to be turned on for you to get this deduction, but there are quite a few rules that we must consider. For joint filers, $6,000 per person of additional deductions if your AGI, your adjusted gross income, is less than $150,000, and it phases out from $150,000 to $250,000, again, of that AGI, adjusted gross income. For single filers, it's mostly the same, but the dollar amount in which it turns off is a little bit different. So it's the same $6,000 additional deduction if AGI is under $75,000, but it phases out from $75,000 to $175,000. Now for these, whether you're single or married, you have to be 65 by the end of the year. So by December 31st of that year, you must be 65 to get this enhanced bonus senior deduction. And then from there, the standard deduction is also now increased this year. It's up to $16,100 for single filers and $32,200 for joint married filers. And you still get the additional senior deduction that was in place prior to 2025, and that is this year in 2026, $1,650 per person if joint, or if you're a single filer, $2,050 for yourself. All right, now let's cover the charitable contributions deduction. So how the tax code works is if you're taking the standard deduction, then generally contributions to church or charity are not going to be deductible. You have to itemize your deduction in order to get that charitable contribution deduction. But starting in 2026, we see that for single filers, if they give to church or charity from their bank or from their wallet or purse, that they can give up to $1,000 and still take the standard deduction. And then similarly for joint filers, they can go ahead and give $1,000 each or $2,000 combined to church or charity, these charitable organizations, and still take the standard deduction. So this charitable deduction can be written off your tax return, again, even if you itemize your federal deductions. So again, Dylan Stewart here with Mainstay Capital Management, a senior wealth advisor on the team, and we're looking forward to being able to serve you into the future should you have any retirement planning or investing questions down the road. Talk to you soon.